Welcome back. So it's been a rough couple years for Alibaba. I mean, if I go back to October 2020, they're down about 70%, 71% from that peak. All right. So between, I would say, the Jack Ma incident, the lockdowns in China, the delisting fears, and then just the general down stock market, it's just been a whirlwind of hurt for Alibaba. And then you combine that with some underperforming quarters, and it's just like the perfect storm to pummel the stock down. All right. So my plan is to go over the quote up top from Charlie Munger. Then I'm going to enlist the help of ChatGPT to see what they think about Alibaba or it. I don't even know what to call that. And then I'm going to go over the most recent quarters of financial data and see if we can come up with a new valuation for the company. All right, so let's talk about this quote up top. So Charlie Munger in the Daily Journal shareholder meeting that was posted, I'll link it and I'll actually timestamp where he said this, but he said something along the lines of like, Alibaba was one of his great mistakes because he was mesmerized or entranced by the idea that they were going to be this dominant player in the Chinese internet, but didn't really see that they were just a retailer like every other retailer. All right, so that got me thinking, like, what makes a retailer bad? What makes a retailing company bad, right? And I have some ideas, but I wanted to see what ChatGPT thought about it. So this is my ChatGPT window, and I asked it straight up, what makes retail sales a hard industry to compete within? And it gave a few reasons: intense competition, that's kind of general, changing consumer preference, price sensitivity, inventory management. I think 3 and 4 are big ones, especially the price sensitivity in a downturn in the economy. I mean, that's retail's like the first to go. Okay, so I thought that was neat. Real quick though, let me show you another cool tool with ChatGPT. I'm gonna open up another window and I'm gonna say, can you describe the bull case for investing in Alibaba? And give it a question mark. All right, let's see what it says. Here's some points. Okay, strong market position, largest e-commerce company in the world, diversified business model. What they do extends beyond e-commerce with investments in cloud computing, digital media, expanding global presence. And this one's interesting. While their core markets in China, that they could expand elsewhere, especially, I mean, maybe not all the way to the States, but definitely, Southeast Asia, India, and maybe Europe. And then strong financial performance. We'll see about that. And then innovations and new initiatives. I would never count on innovations to invest in something, but it is kind of like an added bonus. All right. Now I'm curious though. Now do the bear case. Let's see if it even takes that. Regulatory risks. Okay, we all know about that one. Competitive pressure. Yeah, I mean, it's like that's what goes back to what Charlie Munger said. It's just a retailer. Geopolitical. Lack of transparency, that's one I agree with about China. Dependence on China's economy, another sticky point. Okay, but look, that's just interesting. That's just that's ChatGPT's thoughts on Alibaba. I do this for all my investments now. It's like, if nothing else, it gives you like something else to go research, okay? So now what I want to do is go into Alibaba's financial statements. All right, so this is their income statement, and what I have is every quarterly report going back to June 2014 through December 2022, and just have all the values, and we're going to run through and try to get a financial picture for the company. Okay, so total revenue, you have to see this growing, especially if you're going to be paying a high multiple on PE. If you're expecting a high earnings growth, it's almost impossible to grow earnings without growing revenue, right? I mean, you can do it, but it's much easier if you're also growing revenue. The other thing I want to look at is the gross margin. And this is really important for retailers because what happens, and I think you're actually going to see it here, their gross margin has just been shrinking for the last few years, which is not good. But I think it goes to the point that Charlie Munger said about retailers that, it's so hard to compete because consumers are so price sensitive that in order to keep your market share, even gain more market share, you just have to lower prices if you have more competition, right? So this is a little concerning, but it is nice to see them starting to tick back up slightly. So I'll be curious to see what it is the next few quarters. All right, so what does this translate to? Well, it translates to pre-tax income. I mean, after operating income, and then you subtract out all your non-operating expenses, then you're going to get to pre-tax income. Now, this is what spooked a lot of people. And you know what? I'm going to show you on the earnings per share because I think that shows it better. This is the earnings per share on a trailing 12 months basis. Yeah, look at this. You remember about a year and a half ago, whenever we did Alibaba, the bull case was that even though it was selling at a modest PE, like I don't know, 15 or so, like not a crazy low PE, like it was selling at a reasonable PE. The idea was that the growth rate was so high that it was going to outgrow its PE. And what it proceeded to do was not grow earnings, but shrink earnings and almost go negative on a yearly basis. Okay, so you got to remember that this is a trailing 12 months number, so this is a full year number. So are they going to start climbing back up? That's where this new quarter comes in, and now I'm going to take it off the trailing 12 months and just show you this most recent quarter that I think was great news is that they earned close to 18 per share, which is great. Okay, so that if they continue that, the 18 times 4, that's 72 per share for the year. Okay, so that's really good. We'll see if that's going to continue, but we're going to keep that number in the back of our heads once we get to the valuation, okay? All right, that's enough the income statement. Let's go to the balance sheet. Okay, so what I have here is total equity, and this is just how Yahoo Finance classifies it, total equity, gross minority interest. This was another point to the bull case, I would say, was that the equity just kept on growing, so you were buying shares in something that was growing equity per share, right? Well, it's been flat. Okay, now the good news is, even though they've been close to losing money, if not losing money some quarters, they're not losing equity, which is good. Something else that you really got to pay attention for on retail companies is inventory. Yeah, that we don't have good data there. Okay, and that's just a problem with the Chinese companies in general. I really don't even have good cash flow data either. Let's see, account receivables. Okay, I have some account receivable data, but I don't know if I trust that because it was 0 for a couple quarters. Yeah, this just goes back to the issues with the different reporting laws and stuff for the Chinese companies versus U.S. companies, and then how Yahoo Finance then breaks it down. Anyway. Let's look at their total debt. Total debt is 160 billion yuan, and if you remember, we were talking about on a pre-tax basis they were earning 72 per share. Well, what is that? Let me go back to the income statement real quick. What was that pre-tax income? Pre-tax income was, let's just say 40 billion a quarter. Let's say 30 billion a quarter. So 30 billion a quarter is 120 per year. So look at this. This is awesome. So look, 160 yuan, 160 billion is their total debt, divided by 120 is like a conservative pre-tax income. They're able to pay off all their debt in 1 1/3 year. Okay, that's really strong. That's a great debt position to be in. All right, but that's really it for the updated financials. Like I said, I couldn't really get good data for the cash flow statement, so I'm going to go straight to valuation. So what I have here is future PE valuations. So basically, we're going to put in what we think the earnings per share are now, how many years we're going to do the analysis for, then what's going to be the compounded annual growth rate for that time, what's the future PE, and then what's our discount rate. Okay, and we do all that and we get to net present value. All right, so first off, I said let's take the optimistic scenario that 72 yuan per share. I need to get that to US dollars, so I'm going to multiply by 0.14. That's the conversion. So 10.08, I'm just going to say $10 a share right now that they're earning or projected to earn, let's say. I'll do the analysis for 10 years, and then earnings growth rate. Okay, so let me go back to the income statement because I want to kind of predict the earnings growth. All right, so this is the quarterly values, and remember I used 18 times 4. That's how I got that 72 value. All right, so let's try to estimate one. Let's say 2019 was, let's say 12.5 to 18 in 4 years. So I do 18 divided by 12.5. and then raise that to the 1/4, and that is my growth rate. Okay, so 9.5%. I mean, to be more precise, you subtract 1, multiply by 100. Okay, 9.5%. I'm going to be even more conservative than that. I'm going to say they're going to grow at 8% per year. Okay, so let's go back to the valuation. All right, so 8% a year, I think they're going to grow, which means that in 10 years, they should be earning about $21 a share. Future PE, I'm going to say 15. I think that is a good conservative PE, especially for them. And then a discount rate, I'm going to say, for fair value reasons, I'll say 12.5. And that gives me a net present value right now of exactly $100 a share. It's pretty interesting, right? So That means that they're a little bit on the discounted side right now, but it's not a crazy discount. What's interesting is how different this is than my other videos, because I think my other videos a year ago on Alibaba, I thought they were worth at one point like $200 a share and another point like $150. But you got to change your reasoning as the facts change, okay? And the facts did change. They really, I would say, underperformed what the expectations were for those valuations. But that being said, if they ramp up this growth rate, if they grow it, let's say they grow it 12% a year, they get a 20 PE. Now you're talking about net present value being back to that $191 a share. It really relies on these assumptions that you put in here, okay? But anyway, that's all I got. I hope you enjoyed the video. Please like, subscribe, watch more, and I'll see you next time.